They didn't teach this in school. Inflation is how empires whisper their decline. You feel it in the grocery aisle. History recorded it on crumbling coins and burning banknotes. It is the silent tax that can redraw class lines, topple governments, and change the course of wars. And right now, the past is tapping us on the shoulder, because the next chapter of inflation may already be underway. This is Hidden Finance, where we decode the forces behind your money and the stories your wallet can't tell you. Today, we're going to strip away the myths and follow inflation across centuries, from Roman mints to modern algorithms. We'll uncover the hidden mechanics that drive prices, why it keeps returning in new disguises, and what the next decade may hold. By the end, you'll see inflation not as a number on a chart, but as a mirror of power. Stay with us because understanding inflation's past is the first step to navigating what's coming next. Inflation is commonly described as too much money chasing too few goods, but that tidy line misses the drama. It's also a story about bargaining power, about who writes the rules when resources are scarce, and who pays for yesterday's promises. It moves through households like weather, but it forms in the stratosphere of fiscal policy, central banks, and geopolitics. It punishes savers in cash and rewards those with debt, while blurring the scoreboard for everyone else. Most of all, inflation is a test of trust. Trust that money tomorrow will buy what it buys today. Money itself is a social technology, an agreement that this thing we pass around will store value, measure value, and move value. Across time, societies tied money to anchors, precious metals, fixed exchange rates, the credibility of institutions. When the anchor holds, prices drift within a channel. When the anchor cracks, prices lurch. People adapt in subtle ways. They hoard, they trade faster. They demand wage adjustments. They seek safer assets. Inflation is not just arithmetic, it's the choreography of millions reacting to a broken promise. Consider ancient Rome, where emperors financed expanding borders and restless legions with alchemy. Not sorcery, they shaved the silver. The pure denarius that once rang with integrity slowly filled with base metals. Each new issue worth less than the last. Soldiers demanded higher pay, merchants hiked prices, and citizens learned the new math of survival. The state tried to hide it with fresh stamps and official proclamations, but markets saw through the costume. Over time, coins that looked the same no longer meant the same, and confidence, the true currency, began to evaporate. Desperation produced the Edict on Maximum Prices in 301 CE, a sweeping law capping prices and wages under penalty of death. On paper, it was order. In practice, it was panic in legislative form. Goods vanished from official markets and reappeared in hidden ones, at prices that respected scarcity rather than edicts. The tax collectors shifted from coins to grain and livestock, an admission that the unit of account had lost its anchor. Rome didn't collapse because of prices, but inflation revealed the fracture lines that power could not mend. Centuries later, China pioneered a different marvel: paper money. The Song Dynasty's merchants and officials turned receipts into currency, a brilliant tool for a vast economy on the move. But paper is only as strong as the trust behind it, and overissuance under the Yuan dynasty, famously described by Marco Polo, sparked waves of inflation. People fled to silver and barter, and the paper promises that once sped commerce became a cautionary tale. The lesson was durable. Technology can change what money looks like, but it cannot change the physics of credibility. By the 16th century, the world experienced its first truly global inflation. Silver torrents from the New World flooded Europe, swelling the money supply faster than goods could keep pace. Prices rose 3- to 4-fold across a century, a slow-motion earthquake known as the Price Revolution. Wages failed to catch up, squeezing peasants and artisans while merchants and landholders thrived. Inflation wasn't just an economic event, it rebalanced society, financed distant wars, and taught rulers that scarcity could be taxed invisibly. In 18th century France, a visionary named John Law tried to re-engineer money itself. He founded a bank, issued paper notes, and tied them to the promise of future riches in the Mississippi Company. For a dazzling moment, Paris floated on a tide of liquidity and hope. Then the tide went out, revealing overissuance, speculation, and hard limits on trust. The crash of 1720 took prices and confidence down with it, searing a generational fear of paper money into French memory. Decades later, the revolution's assignats, paper backed by land, met a similar fate, and inflation again taught a brutal lesson about overpromised stability. America's story is a collage of the same themes. The Revolutionary War was financed in part by printing continental currency. Soon, "not worth a continental" became a phrase that stung. During the Civil War, the Union issued greenbacks, and prices surged, while the Confederacy suffered a near-total currency collapse. Afterward came a long taste of deflation under a hard gold standard, a boon for creditors but a burden for farmers and debtors. The fights over silver, the 1896 Cross of Gold speech, and the populist revolts were really arguments about inflation, about who gets relief and who must endure. Then came Weimar Germany, inflation's most famous fever. Reparations, political chaos, and a government desperate to survive set the printing presses ablaze. Banknotes multiplied until they became props in a tragic theater. Wages paid twice a day, prices doubling between sunrise and sunset. Savings dissolved like salt in rain. Debtors escaped burdens overnight, while savers learned that thrift can be a trap when the unit of accounting is melting. Currency reform finally reset the table, but the social trust shattered in those years never fully healed. After the Second World War, the world tried a new anchor, Bretton Woods. Currencies were fixed to the dollar, and the dollar promised convertibility to gold, a hybrid faith in metal and American credibility. The arrangement powered decades of stability and growth, but it carried a contradiction: the world needed dollars, while too many dollars strained the gold promise. By the late 1960s, war spending and domestic programs pushed the system past its limits. In 1971, President Nixon severed the final link to gold, and the age of pure fiat money, inflation's favorite hunting ground, began. The 1970s delivered the body blows. Oil embargoes and geopolitical shocks collided with policy choices, producing stagflation, rising prices with weak growth. Households learned new rituals, cost of living adjustments, wage negotiations, and lines at gas stations that seemed to loop time itself. Trust in technocrats faded as forecasts failed and the price of stability felt impossibly high. Then a new decision reshaped the future: the Volcker shock. Interest rates lifted like a drawbridge to starve inflation of oxygen. It worked, but at a cost: deep recessions, shuttered factories, and political backlash that still echoes. The payoff was the Great Moderation, a long era from the mid-1980s to the 2000s when inflation became a background hum. Globalization brought cheaper goods. China's rise expanded labor supply, and technology streamlined production and logistics. Central banks earned reputations for independence and inflation targets that sounded like thermometers set precisely at 2%. We relaxed, and for a generation, inflation seemed tamed, if not defeated, then domesticated. Then the 2008 financial crisis cracked the facade in a different way. Central banks created oceans of reserves and bought bonds in unprecedented amounts. The feared inflation didn't arrive at the checkout line. Instead, prices inflated on Wall Street: stocks, bonds, real estate, while wages and consumer prices barely budged. The problem wasn't too much money circulating, but too little demand and broken banking pipes to carry it. We learned that not all money multiplies the same, and that inflation can choose assets over groceries. The pandemic rewrote the playbook with brutal speed. Factories idled, ships backed up, and governments fired fiscal cannons straight into household bank accounts while central banks kept money cheap. Demand rebounded faster than supply, and a global inflation wave followed, then intensified as war rattled energy markets and Europe paid a heavy price for gas. By 2022, central banks slammed the brakes with the fastest rate hikes in decades, and inflation began to cool from its peaks. But underneath the headline disinflation, a new argument took shape. What if this wasn't just a cycle, but a regime shift? Here are the turning points that matter. First, watch the anchor. Every inflation storm begins when money's anchor gold, credibility, rules weakens or breaks. Second, wars and crises force fiscal hands, and inflation becomes the path of least resistance, the tax without a vote. Third, institutions matter. Independent central banks can buy time, but they can't repeal math if politics demands spending. Finally, memory fades. Generations that don't remember inflation let debts swell and anchors fray until the story returns. The pattern isn't perfect, but it is persistent. Inflation doesn't strike evenly, it chooses winners and losers with cold precision. Debtors find relief as real burdens shrink, while savers in cash pay a fee for safety they didn't know they agreed to. Owners of scarce assets, real estate, commodities, infrastructure often gain, while wage earners without bargaining power fall behind until contracts catch up. Emerging markets feel it hardest, with currency collapses and IMF rescues carving lost decades into national stories. Social trust erodes when the price of milk becomes a political symbol, and societies reach for strongmen or simple answers. Governments, too, are not neutral observers. Inflation can sand down the mountain of public debt, easing fiscal pressures without a formal vote to tax or cut. It also tempts those in power to prioritize today's emergencies over tomorrow's consequences, risking a return to stop-start cycles that punish the least resilient. The boundary between monetary and fiscal policy blurs in crises, and once blurred, it is hard to redraw cleanly. That is why inflation is never just economics, it is governance, fairness, and legitimacy playing out in the language of prices. So what's about to happen next? For forces are gathering that could keep inflation more volatile than the placid years before 2020, debt and deficits that won't shrink quietly, an aging world that changes labor and spending patterns, a rewiring of globalization that raises costs, and a massive energy transition that demands upfront investment. At a fifth defense as geopolitics turns colder and supply chains grow redundantly expensive. None of this guarantees runaway prices, but it leans the table toward a higher resting heart rate for inflation. Central banks may tame each flare-up, yet face a political reality that makes holding rates too high for too long difficult. The risk isn't a straight line up, but a choppy decade where inflation slips, then reappears when shocks collide with policy limits. Technology is the wild card with a double edge. Artificial intelligence could make services more productive and blunt wage pressures, repeating the deflationary force of previous tech waves. Yet the build-out itself, chips, data centers, grid upgrades, demands metals, energy, and time, pushing up prices where capacity is tight. Productivity miracles usually arrive messy and lopsided, lowering some costs while raising others until the system recalibrates. If technology outruns bottlenecks, it can steady prices. If bottlenecks outrun technology, it can stir volatility. The balance between the two will write much of the next chapter. Here's what to watch if you want to see around the corner. Follow public deficits and whether markets demand higher yields to fund them. That's the pressure point where fiscal and monetary policy collide. Watch wage growth versus productivity, because persistent gaps feed service inflation that doesn't fade quickly. Keep an eye on supply choke points, shipping costs, energy capacity, critical minerals, since scarcity there spills into everything. And track inflation expectations, the thermometer inside our heads. When they rise and unmoor, history shows policy must act harder and faster. Inflation has always been a mirror held up to power, revealing the trade-offs leaders would rather keep off the ledger. It whispers that stability was never free, and that the true cost of yesterday's decisions arrives, eventually as a higher price today. We are not doomed to repeat the worst chapters, but neither are we exempt from their logic. If there is a lesson into millennia of money's misadventures, it is this: credibility is the anchor you notice only when it snaps. In the years ahead, the nations that rebuild it fastest will pay the lowest price for their future. Inflation is not a number, it's a choice, made in public budgets and private behavior, one decade at a time. If this journey changed how you see the price of everything, Stay with Hidden Finance, where we surface the signals beneath the noise. Subscribe on YouTube, follow us on Facebook, and share the moments when inflation rewrote your life. Your stories are the data history forgot. New episodes every week uncover the forces shaping your paycheck, rent, and retirement before they shape you. This is Hidden Finance, because when you understand the money story, you don't just survive the future, you claim it.